What's going on, everyone? Welcome back to the channel. So in today's video, I'm just going to be discussing scaling in and scaling out of trades. So first of all, what is scaling in and out of trades? So scaling in, let's say right now, market has curled over a lot. I would not want to buy my full position of 10 micros right now. I don't know, the market could easily keep going down. I don't see the reason to, fully take a risk, especially at a point where I don't know if we've bottomed yet. So what I'm going to do is only put in and buy 2 or 3 micros, so only 20 or 30% of my real full-size position. And if the market is accumulating here and it holds above that low, then great. Now, if the market looks good, I can go and add another 5 contracts, or just add another 7 or 8 contracts and be at my full position, and then set my stop loss. And it also works really well when you're scaling in, because if my full risk limit on 10 micro contracts is $250 on a 5-point stop loss, if I'm at 2 or 3 contracts, I would be able to risk like 30 points to be able to get to that $250 loss. So I could risk like 20 plus points of drawdown and still not even be at my true risk limit that 1 or 10 ES micro contracts would be. And that's good, because if there's a lot more manipulation and some more downside, then I can just hold through that. And then if it pumps back up here, and if it just rallies and retraces, well then on the retrace on that rally, I can just go and add in the rest of my position. And if it's obvious that the market probably bottomed here on high volume, just really pukey action into a level and then sharp retrace rally, boom, then I don't have to risk my full position. I can just weather the storm a lot better with smaller size. Right? So that's a lot of the benefits of scaling in. Now, granted, that is more so, that's more so just in times of a lot more uncertainty. I don't really scale into trades in, the first 30 minutes or hour of the day. I just don't really see a reason to, because the moves are a lot more predictable and the moves are also just a lot faster. So if you're scaling in to a trade in the first, couple minutes of the day, it's probably going to move in the direction that you want it before you can put on your full position size. So it's just not that ideal. And one thing that you want to make sure that you're not doing when you scale into trades is adding to a losing position, right? You don't want to add, if you bought right here at 14,300, you don't want to add, all the way down here, right? You only want to add when it's pretty darn close to that or showing really good signs that this is a bottom. So for example, look at that volume, right? Tons of volume, way higher than here, getting bid up off of 14,240, right? Kind of looks the same off of ES. Tons of volume right now. Tons of volume. If we don't break below this price by like 10 plus points on NQ or 5 plus points on ES, that's probably going to be the bottom for the day. So if I was getting in now, right at 14,140, let's say 2 to 3 micros, now that kind of shows signs that is most likely going to be the bottom. So now, assuming that, this flips green and we see a little more green candles, then cool. Now I'll add another 2, 3, 4, 5 plus contracts and get to my full size. Because now I just avoided that liquidity grab and just stopped out a bunch of people. Right? That's why you want to scale in times of uncertainty, and to not get stopped out on times of uncertainty where market makers are just trapping, retail traders and are just destroying their accounts and just totally rating their stop losses. Now, scaling out is the exact opposite of scaling in. It's when you're already in a position and you take off 10, 20, 25% at a time when the trade does go in your favor. So let's say that you shorted off of this 14,160 rejection and you're already 10 points in profit at this point. You would probably want to lock in at least 50% of profits at this point, right? Because for me, anything 10 plus points on ES, that is already my goal. I mean, 10 plus points, awesome. On 10 micros or 1 mini, that's $500, right? That's cool. That is great for me. So, and the thing about scaling out though is that you want to make sure that the price or the chart is looking like it can continue in that direction. If it's not, right, if buyers now are really getting aggressive at 41.50 here, then yeah, I would probably get out of like 80 to 90% of my position and hold maybe 1 micro as a runner and try to catch some more of that move so you don't feel FOMO. But if it's not showing signs it's going to keep going down, yes, get out. But if it is, right, and we're going to go and crack below this 14,150 level now, then yeah, I might just get out 50%, lock in $250, and now I have $250 that's floating. So if price goes back down to my entry, well, then it's a risk-free trade at that point. But it also wouldn't, because I'd be protecting my my trade with, I'd move my stop loss just above my entry. But then, right, let's say price is trading around 4,150, and then we get this little break right here. On that break of 5 plus points, scale out another 1 or 2 contracts, right? Another red candle, scale out another 1 to 2 contracts, right? And then you see 2 green candles. Yeah, don't just get out because you see some green candles, right? I mean, if you would have scaled out on just this green candle right here, you would have missed another 100 plus points minimum, right? So don't be afraid to hold through green candles. I mean, you're always going to have green candles in super bearish days, and you're always going to have red candles in super green days. There just happened to be a little bit more buying right here, a little bit more shorts covering, a little bit of early longs thinking that, they could long there, and that's all it is, right? But it is, scaling out just allows you to catch more of the move because you're not going to feel as much of FOMO or as much fear of if price retraces back to your entry. Well, now you just gave up that entire profit potential and now you're at 0, right? And FOMO, for solving FOMO, if you're in just a little bit of a trade, just catching a little bit of profit on these moves, you're not going to really feel FOMO. Like, it diminishes massively. If you're in even 1 mini or a micro contract and you sold off most at 14,150, but you're just in like 1 micro, you're still going to be happy that you caught the trade. You still are making money. Yeah, it's not going to be your full size, not even close, but you're not going to be pissed because, oh, if I just would have held. Well, you did hold and you could have shorted more, but you didn't. So that's how scaling out can also help you in your trading psychology, because you're, like all the stuff I said, you're locking in profits, you're not going to feel FOMO. It's just really, really good to scale out of trades, and I honestly prefer scaling out of trades more than scaling in. There's times for scaling in, there's times for not scaling in, and I think it's usually just easier to just get in your full position from 9:30 to 10:30 or up to like 11, which is when I trade. If you're trading midday and there's like a massive move, or I mean honestly, even like let's say at 9:35 or 9:40, if there was a super large morning flush or morning pump and there's like no green candles in the ton of red candles or no red candles in a ton of green candles, then yeah, maybe you would take 20% of your full position and go short or go long at whatever point And then if price starts to now come down or come up from that zone, well, okay, cool. Now you can go and look to add more to your position. But if that doesn't happen, well, cool. You just avoided not taking a full, full stop loss and a full just L on that position. So, yeah, I think, just scaling out is just one of the best things that you can do that's going to help your trading executions by a mile. And by the way, all right, if you look right here, now again, we could easily come back down, but right here, price is now looking like that might have been the bottom. When you see a ton of volume like this, that means that there was a ton of accumulation, right? If there's a ton of volume and there's a big red candle, well, that means that sellers just washed out all of the longs that are trying to push price back up. But right now, bulls are in control. And they just washed out all the sellers that tried to push price down. The buyers absorbed all the selling pressure. And now price is reversing at least 6 to 7 points from that area, or 10 points from that exact low. So right now, I would think, okay, if I'm in only 20 or 30% of my position, I might look to go add another 5 contracts. Right? And if we can hold above 41.40 or 41.38, awesome. Well, I'll be in now my full position, add another 2 contracts, and we're good to go. Let's see if we can go retest VWAP now. So I think that's pretty much all I have right now for scaling in and out of trades. There's really not a lot more that I can say about it, but I just want to make you guys aware that that is a thing. And yeah, it really, really helps to not always be full size, because it just allows you to be a little bit more clear and a little bit less emotional when you have your full size. And when you just cut that in half, it just becomes a lot simpler to put on more risk. So I hope you guys enjoyed this video and just got a decent amount of value. And now you can go and try scaling in and out of trades yourself. So once again, thank you guys for watching. Hope you guys enjoyed, and see you guys in the next one.